Bitcoin will hit $1.3 million per coin. At least that's what Bitwise is projecting. Now, Bitwise isn't your typical Wall Street firm. It's one of the largest crypto-native asset managers in the world. They built their reputation inside crypto, but they've earned the respect of institutions after launching some of the first Bitcoin ETFs. And here's the twist. A decade ago, most of traditional finance dismissed Bitcoin as a scam. Today, a crypto-native firm is publishing research in the same format as JPMorgan or BlackRock, and they're calling for a $1 million Bitcoin. So what changed? Why is Bitcoin suddenly being modeled like stocks, bonds, and real estate? And what does Bitwise see that others are missing? In this video, we're going deep into their latest report, exploring why they believe Bitcoin could 12 times in the next decade, how US debt, global currency wars, and regulation all factor in, and the very real risks they warn could derail it all. Before we dive in, most people watching right now aren't subscribed. If you're enjoying the content, hit that subscribe button. It's free, it helps the channel grow, and you can always change your mind later. All right, let's get into it. So what even is this report? Every year, big investment firms like JPMorgan, Vanguard, and BlackRock put out something called capital market assumptions. These are long-term forecasts that institutional investors use to build their portfolios, usually 5 to 10 years out. They cover stuff like, we expect US equities to return 6% annually, or bonds should average 4%. Think of it as Wall Street's playbook. And for the first time ever, Bitcoin has its own chapter. That's huge, because it means Bitcoin isn't some fringe speculation anymore. It's now considered in the same breath as stocks, bonds, gold, and real estate. Bitwise just published their inaugural Bitcoin long-term capital market assumptions. And the headline number is insane. $1.3 million per Bitcoin by 2035. That's a 28.3% compound annual growth rate from here. Compare that to stocks at 6%, bonds at 5%, private equity at 10%. Bitcoin blows everything else out of the water. But how did they get there? Let's break it down. First, Bitwise says, Bitcoin is first and foremost a macro asset. Translation: you can't forecast Bitcoin without looking at the global economy. And the backdrop is, well, let's just say it's tailor-made for Bitcoin. The United States is about to celebrate its 250th birthday. And the timing couldn't be more ironic, because just as the country hits that milestone, its debt is spiraling out of control at a pace no one can ignore. Think about this. In its first 200 years, America racked up about $650 billion in debt. That's it. Today, that number isn't billions anymore. It's $36 trillion. And half of that was added in just the last 10 years. To put it another way, every US citizen is now effectively on the hook for more than $100,000 in government debt. And the interest payments alone, just the cost of keeping the lights on, are nearly $1 trillion a year. That's now the fourth largest expense in the federal budget, bigger than many entire government programs. As analyst Lynn Alden put it bluntly, nothing stops this train. And history tells us what happens when governments find themselves in this position. They don't suddenly tighten their belts and balance the books. They reach for the same tool they always have, the printing press. They inflate their way out. They sacrifice the currency to keep the system afloat. Ray Dalio said it years ago, and it rings louder than ever today. When countries have too much debt, lowering interest rates and devaluing the currency is the preferred path. That's the path the US is on right now. And it's exactly the type of environment where Bitcoin thrives, a scarce, non-sovereign asset designed to do the one thing the dollar cannot: protect your purchasing power. Bitwise also highlighted a moment that almost feels like satire. In early 2025, President Trump tapped Elon Musk to lead a new Department of Government Efficiency, nicknamed, of course, DOGE. The mission? Cut $2 trillion in federal spending. 6 months later, Musk is gone, Doge has accomplished virtually nothing, and US spending has surged to record highs. The message is pretty simple. If even Trump and Musk together couldn't slow the growth of government debt, no one is going to. Which means one thing is guaranteed: fiat debasement is here to stay. Bitwise isn't calling for hyperinflation or a dollar collapse. What they do see is something more subtle, but just as powerful: a steady erosion of the dollar's purchasing power over time. Institutions already recognize this. It's why gold and Bitcoin, the two leading non-fiat hedges, have quietly outperformed every other major asset since 2020. That outperformance isn't a fluke. It's the market preparing for a world where fiat buys a little less each year, and where investors need real insurance against that trend. And according to Bitwise, this is only the beginning. Another major trend Bitwise points to is the slow decline of the US dollar's dominance as the world's reserve currency. Its share of global reserves is shrinking, its share of global GDP is slipping, and central banks are buying record amounts of gold as insurance. Bitwise argues that Bitcoin could soon join that table. More than a dozen countries, including the US itself, already hold some BTC. And unlike gold, it's easier to store, easier to transport, and impossible to inflate. In a multipolar world with multiple reserve assets, gold will always have a seat, but Bitcoin may be next in line. The last piece of the puzzle is regulation. After the 2024 election, the US flipped from hostile to openly pro-crypto. Spot Bitcoin ETFs were approved, the Genius Act for stablecoins sailed through Congress with bipartisan support, and suddenly, Wall Street heavyweights like BlackRock and JPMorgan were racing to launch crypto products. Bitwise sums it up perfectly. You can't put the genie back in the bottle. Crypto has crossed into the mainstream, and with both Wall Street and millions of everyday Americans now invested, no politician is going to risk reversing course. So when you put it all together, spiraling debt, a weakening dollar, and a regulatory landscape that's finally turning favorable, you get what Bitwise calls the perfect storm for Bitcoin. Now to the meat, Bitwise's actual Bitcoin assumptions. They say three forces will drive Bitcoin higher over the next decade. Number one, institutional demand. This is the big one. Institutions today control an estimated $100 trillion in assets worldwide, and yet the vast majority of them have zero exposure to Bitcoin. That's what makes Bitwise's forecast so striking. They believe that over the next decade, institutions will begin carving out between 1% and 5% of their portfolios for Bitcoin. On paper, that doesn't sound like much, but in practice, it translates to between $1 trillion and $5 trillion in fresh demand. And here's where the math gets brutal. At current prices, only about $18 billion worth of new Bitcoin is mined each year, which means institutions won't be able to rely on fresh supply. They'll be forced to buy from existing holders. That dynamic, massive inflows colliding with inelastic supply, is what creates supply shocks. And it's the kind of pressure that can send prices to levels most people still think are impossible. Number two, limited supply. On the other side of the equation is Bitcoin supply. And this is what makes it so different from every other asset on Earth. The total cap is fixed at 21 million coins. Nearly 19.9 million of those already exist, meaning the vast majority of Bitcoin is already in circulation. New issuance is shrinking fast. The inflation rate sits at just 0.8% today, and it will fall to 0.4% in 2028 and 0.2% in 2032. For context, the gold supply typically grows between 1% and 2% a year. Fiat currencies, they can expand overnight with the stroke of a pen. Bitcoin doesn't play by those rules. No matter how much demand rises, supply won't budge. And when you pit trillions in new demand against a fixed cap, the outcome is simple economics. Prices have nowhere to go but up. Number three, fiat debasement concerns. The final driver is the one that ties everything together. Fiat debasement. Institutions are increasingly uneasy about the relentless growth of debt and deficits. They know where this road leads. Currencies slowly lose their purchasing power, and anyone sitting in cash gets punished. What they need is a hedge. Legendary investor Paul Tudor Jones put it bluntly back in 2020. The best profit-maximizing strategy is to own the fastest horse. My bet is Bitcoin. That sentiment has only grown more relevant as the numbers have gotten worse. And that's the backdrop for sustained inflows. It isn't just speculation or hype driving adoption anymore. It's the cold reality that in a world of weakening currencies, Bitcoin is increasingly seen as the strongest alternative. So how does Bitwise actually land on a 1.3 million Bitcoin? It comes down to a simple but powerful model. Looking at the markets Bitcoin can realistically penetrate and asking what share could it take by 2035? Think of it as a total addressable market analysis. Bitcoin isn't just competing with gold anymore. It's eyeing a whole menu of global markets. The 92 trillion store of value market, the 216 trillion sitting inside institutional portfolios, trillions more in national reserves, corporate treasuries, offshore wealth, and even remittances. These are some of the largest pools of capital on the planet. Now, Bitwise isn't assuming Bitcoin dominates all of them. In fact, their assumptions are deliberately conservative. In the base case, they estimate Bitcoin captures about a quarter of the global store of value market, meaning gold and Bitcoin together become the twin pillars of hard money. Then they layer on just slivers of exposure from the other categories, a few percent of corporate treasuries, a couple points from national reserves, and so on. Add it up, and you get a price target of roughly $1.3 million per Bitcoin by 2035. That's their base case. On the low end, their bear scenario comes out to about $88,000, which assumes Bitcoin's penetration barely grows from today's levels. On the high end, the bull case pushes toward $3 million if Bitcoin wins bigger shares of these markets. That's the math. It isn't magic, it isn't wishful thinking. It's a straightforward supply and demand calculation applied to some of the biggest markets in the world. And Bitwise's view is that even a modest foothold in these markets is enough to make Bitcoin the best performing institutional asset of the next decade. Here's where it gets interesting. Bitwise didn't just model Bitcoin in isolation, they stacked it up against traditional assets. Their forecast for the next decade calls for Bitcoin to deliver average annual returns of about 28.3%, with volatility around 33%. By comparison, US stocks are projected to return roughly 6%, bonds under 5%, gold just over 4%, and even private equity only about 10%. Yes, Bitcoin is more volatile than all of them, but on a risk-adjusted basis, it still comes out on top. And the kicker is its correlations. Over the last decade, Bitcoin's relationship to other assets has stayed remarkably low, near zero with bonds, barely a tenth with commodities, around 0.2 with stocks, and almost nothing with gold. In plain English, Bitcoin marches to its own beat, and that's exactly what makes it so powerful as a portfolio diversifier. Bitwise isn't blind to the challenges. They point out that Bitcoin's history is still relatively short, which means past returns may not be a reliable guide for the future. Regulation can always shift with politics. Institutional adoption might not accelerate as quickly as expected, and advances in technology, like quantum computing, could pose threats down the line. And of course, volatility will remain higher than what investors are used to in stocks or bonds. But here's the important part. Even after factoring in all of these risks, Bitwise still concludes that Bitcoin is set to be the best performing institutional asset of the next decade. In the end, Bitwise's message is clear. Over the next decade, they expect institutions to pour trillions of dollars into Bitcoin, transforming it from a niche asset into a mainstream store of value. That demand will only intensify as government debt and money printing continue to weigh on fiat currencies, while regulation, instead of holding the industry back, now provides a growing tailwind. Put together, their forecast calls for Bitcoin to compound at roughly 28% a year, reaching about $1.3 million per coin by 2035. And they frame it as more than just a price target. To Bitwise, the next 10 years mark Bitcoin's institutional epoch, the period where it stops being optional and becomes a core alternative asset in global portfolios. As they put it in the final line of the report, over the next decade, Bitcoin becomes a mainstream alternative asset that is difficult for any thoughtful investor to ignore. If you've made it this far, you're clearly serious about Bitcoin and crypto, so do yourself one quick favor. Hit the first link in the description and sign up for my free daily email, Crypto Nutshell. It's written by me and my team every morning. It takes less than 5 minutes to read. We cover the biggest crypto news, expert predictions, and the on-chain data that actually matters. It's fast, it's free, and it will keep you ahead of the curve. Click the link, enter your email, and you'll get tomorrow's issue straight to your inbox. Thanks for watching, and I'll see you in the next one.